Hello dear viewers, Assalamu alaikum. As a part of continuous education, professional development education, I'll have some topics on audit and assurance subject. Today I'll have some topics, that is code of ethics, threat to independence, and how to minimize that threat. It is important parts of our audit profession and for examination. In your exam, in all exam, you have some questions in your case or directly from ethical consideration. Code of ethics is important for every profession, not only our CA CMA ACCA profession. Engineers, doctors have almost same ethical principles, fundamental ethical principles. There is some changes involved, that's humility and anything, but all profession almost have same ethical principle have to be followed. We have to follow our ethical principles given by IESBA, International Ethical Standard Board for Accountants. This is the part of IFSC organization. IFSC is the mother organization or parent. This is another board. First of all, professional accountants fundamental principle have to be comply or to be followed, that is integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Integrity means honesty, but it is more than honesty. Professional accountant must be honest along with straightforward. He is not only honest but should be straightforward in his profession, not to compromise anything else. Objectivity, he don't be biased or have any conflict of interest in discharging his duties and responsibility. Professional competence and due care. Professional accountant must have competence, skills, training, and continuously to be adapted with current worlds, whether in technology or law or anything else. Confidentiality for the clients or whether in service, professional accountant must have confidentiality to disclose any information of his client or of his employer. Professional behavior means he must comply with law and regulation, avoid any activity which will discredit to his profession. These 5 fundamental principles we have to follow as professional accountant. Secondly, the most important is threat to independence. First one is self-interest threat, self-review threat, advocacy threat, familiarity threat, intimidation threat. Self-interest threat, auditor or accountant, if auditor and accountant has interest in the client, financial interest, that is share or any gift, hospitality, fee dependency. Self-review threat, if auditors is engaged with non-audit service which will be reviewed by him. As an example, if an auditor audits and also prepare financial statement or tax service which can be further reviewed by him or challenged by others. That is self-review threat. Advocacy threat. If an auditor advocates himself or works on behalf of the client in the court or anywhere on behalf of the client, that means advocacy threat. Familiarity threat. Familiarity, long-term association. If an auditor is associated with the client in long term, that may be familiarity threat. The relationship or personal relationship with client or any, which may be familiarity threat. Too much interest or too much sympathetic with the client may be cause of familiarity threat. Intimidation threat. Losing your client after thorough dependency, fear of losing clients, intimidation threat. That is 5, threat to independence or objectivity. In any case, whether you find clue or hints, small or big case, the auditor or professional accountant is engaged or facing the threat, you write from the case, that is self-interested, self-review threat, familiarity, advocacy or intimidation threat. You will just classify the threat and write this is self-interested or familiarity threat. You just pick up the event. What should be your answer? That is within 5 threats to independence. How to minimize the threat? These threats can be minimized through 2 ways. Externally, that is training, high skill training or following code of ethics, rules, regulation of the law of the country, or any ethical behavior governed by the institute. And internally, it can be minimized through quality control that we have already discussed in ISQ 1. Elements would be enough to minimize the threats. Safeguards, that is, safeguards mean how to minimize the threats. Already we have discussed leadership, ethics, client relationship, HR, engagement and monitoring. That is 2 ways of safeguarding the threat to independence or objectivity. That's all. We'll go for ISA discussion. Before ISA discussion, we'll have some idea about Worldcom case. Worldcom was established in 1983 in the USA. This was an established company and its growth was wild. And after 1996, the successful company became the losing company because of their attitude of the behavior of management. Management became too much greedy for getting short-term profit. That's the CEO Bernard, CFO and other reporting officer. They were engaged to inflate their profit of Worldcom. That started their manipulation or fraud. This is one of the biggest fraud, accounting fraud in history. We have to learn from the history of collapse of Worldcom after Enron case. That started in the acquisition of MCI, another company. In the acquisition, all new assets are entered in the books and including goodwill. They intentionally raise the goodwill and other income. That's why the profit grew highly than the fair market value. Their target was to achieve more than 50%, whether it is fixed assets growth. This is the violation of GAAP, generally accepted accounting principles. We call it IFRS or IS. That's why they can't do it, but they did for manipulate their accounts to show hidden profits. They misclassified the line cost. They charge all the line cost in the balance sheet or capitalize the all expenses of line cost, that is lease rental. This is the violation of principle IFRS or IS or GAAP. Asset is the resource to be controlled which will give economic future benefit, and these assets would be controlled by the entity according to IFRS and GAAP. Same thing, but you can't capitalize any expenses in asset. This was fraud schemed by CEO Bernard and CFO and reporting officer. CFO and reporting officer was CPA, Certified Professional Accountant. They were engaged in the fraudulent activity. That is cook it by book. The Americans say it cook it by book. We say it according to IFRS creative accounting in our corporate reporting chapter. Other reserve was created for setting up unusual costs and foreseeable loss. Other reserve cannot be used for setting up unusual loss according to IFRS or GAAP. This is another violation. This was found out by internal audit. External auditor Arthur Anderson, who was also auditor of Enron. Arthur Anderson couldn't find any difficulty, material misstatement in the financial account. They didn't check or notify to the shareholders of the board. But an internal auditor head, she is Cynthia Cooper. Cynthia Cooper detected this and investigated thoroughly. That's why the biggest fraud in accounting history was revealed. Cynthia Cooper also an CPA. Cynthia Cooper was head of internal audit. I salute him as an internal auditor. So she is an example of not compromising her integrity or objectivity. This is an example. Other CPAs were engaged in fraudulent accounting, but another CPA who was in internal audit, did not compromise her integrity or objectivity or his ethics. We'll discuss now our next topic, ISA 200, that is overall, that is ISA 200 overall objective of auditing financial statement. 210 is term of engagement. 220 quality control. 230 audit documentation. 240 responsibility relating to fraud in financial statement. 250 communication with those charged with governance. 265 deficiency in internal control to those communicating deficiency to those charged with governance in relating to internal control. Overall objective of the auditor, especially external audit, is to give opinion on the financials, whether financial statements are free from material misstatement, whether it is from fraud or error. And reporting, secondly, auditor has to report on the financial statement. Another things, the financial statement, whether it is prepared in according to applicable framework. This is the responsibility of the auditor. Term of engagement. Term of engagement is easy, very easy. In the term of engagement, audit work is summarized by the auditor in his engagement letter. Please follow Appendix A, engagement letter. This is a specimen for engagement letter. This totally cover the 220 ISA. Just a specimen. Important part is how to perform your audit, the working procedure of audit. The one is material misstatement, material risks. Auditor should find out material risks, policy and procedure, internal control, going concern, and good presentation of this report. These 5 criteria you will find in Appendix A in ISA 210. 220 is quality control. We have already discussed. 230 audit documentation. Audit documentation is the most important working file, permanent file, and electronic file. All files should be reserved for the future reference as audit evidence. It's in summary. 240 responsibility relating to fraud and material misstatement in the financial statement. 250 law and regulation. Material misstatement. 240 is the most important. No auditor is free from performing any work without professional skepticism and professional judgment. This professional skepticism is not present in his audit work, he will be liable to misconfidence, that is negligence. In Kingston Cotton Mill, auditor was not liable as he had got a certificate of inventory valuation given by a director. That's why the judge gave the verdict that auditor is a watchdog, not bloodhound. But in current world, in 240 under 240 ISA, auditor is liable, would be liable if they don't check or perform his duties with professional skepticism and professional judgment, due care and competence, that we have already discussed at first. So court will look for the competence, skill, whether he had applied all the skills to find out an error. Professional skepticism is in questioning mind. Auditor would not compromise his checking or performing procedure with negligence. This is professional skepticism. What we have learned from Worldcom case. If we analyze under 240 ISA 240, auditor didn't check or perform his work with due care and professional skepticism. If they could try to analyze the journal entries given in the books, this would be found out by them, the misappropriation or misapplication of principle. They didn't check thorough the capital assets. The line cost is charged in capital expenditure. So this is another violation of their ethical principle. (250) Law and regulation. They didn't follow law and regulation of their countries prevailing for the audit work, that is gap and anything. 260 Communicating with those charged with them. They didn't work well for detecting fraud and error. External auditor didn't work well, but internal auditor report the fraud case to those charged with governance. That's the example of our learning. So this is my succinct summary of the discussion of ISA 200 to 299 series, and we'll discuss later another 300 series with some practical case happened in the past. So bye for now. Thank you. If you don't subscribe my channel, please do subscribe, like and comment there. I'll be connected with you. Thank you.